And let's look at the long-term finance, the kind of financing methods available for this company, because I believe this will be one of the questions in this paper, because this company seems to be wanting money now.
Right, yeah.
Yeah. Look at this balance sheet, what they have.
Uh-huh.
As I said, the balance sheet has some kind of a problem in the presentation. But if you really look at, they have an equity of 800 million. They're a listed company and they have retained earnings of 400 million.
Hmm.
Loans, they have one category called 350 million. And also there's another kind of a loan called film obligation and production loans, 620 million.
Hmm.
So for me, both are loans. I do not know why they
Hmm.
have put it up under two different categories, but both are loans. So they have 970 million worth of loans compared to 1.2 million equity.
Hmm.
The total equity, you can count it as equity and retained earnings. It is 1,200,000 against the 970,000. So if you take it as a gearing,
Hmm.
you can see it is debt is 970
Hmm.
divided by debt plus equity 1,200,000 plus 970. So if you work it out as
Hmm.
a percentage, you will see it's a fairly a big uh, gearing they have. 970
Hmm.
divided by 2170, which is going to be 45%.
Right.
Yeah, 45%. Not so bad, not so bad, but I believe they have almost reached the maximum because generally, I mean, there's no hard and fast rule, but generally it is believed about 40% gearing is all right for a company. Anything over
Hmm.
40%, it is sort of somewhat in the risky area, and that may be. And
Hmm.
uh, look at your finance charges. Last year they had 48, this year they have 40. So I'm sure their way of charging finances is also another issue maybe. They may be charging the finance of a particular film to the particular film as a charge.
Hmm.
That may be the way that they are charging. Maybe that there are two types of loans what they are talking. The 350 million may be a kind of a unspecified loan. It's not for a particular film, it is for the general company. The other
Hmm.
620 may be all loans taken for film production. If you remember that
Okay.
one weekend in Moscow, what we realized was they have taken equity, but they did not mention anything about loans. But it looks like looking at the balance sheet, they have film obligation and production loan. Film obligations can be anything that we need to pay to the cast or whatever it may be. And loans may be what they have taken to produce the film. Anyway, there is a little
Hmm.
bit of a gap in the whole thing. They might put up something in this area, so we better be ready for it. But what we can see
Hmm.
is the bank, they have only 98 million, not too much of money. They have fair amount
Hmm.
of receivables to receive. That probably is the money they have to get from their customers for selling the films or from the film halls or whatever it may be. That's the
Hmm.
kind of a structure they have. So they, if you really look at to do another film, they don't have enough money. But one thing we realize is they have not gone for equity increase. They have kept equity at 800 million at least for last 2 years.
Hmm.
So in light of that one, there is a need for long-term finance. So what I thought was, let's look at some of the long-term finance sources and what is available for this company.
Right.
So being a listed company, they can go to the market and issue new shares, but they can't
Hmm.
go and issue new shares to new shareholders because they are an existing company. So the only way they can go to the market is to a rights issue.
Rights issue. Yeah.
Rights issue. They can go to the market with a rights issue and issue shares to the existing shareholders. What is a rights issue? Rights issue is issuing shares to the existing shareholders at a discounted price. When the market price is $10, you offer it at $8 to the existing shareholders. So there's some kind of a benefit, a privilege to the existing shareholders. And because there's a benefit and a privilege, the people will try to, whoever who has money will want to buy more of that privilege or the benefit. And therefore you have to ration it. You can't give everything what they are. You have to make it proportion to their existing shareholders. So that's what a rights issue is. It's given at a discounted price, but it is not given unlimited because it will be given in a proportion to the existing shareholders. So that's what we say. For every 5 shares, 2 new shares. For every 3 shares, 1 new share at a discounted price.
Right. Yeah.
And also, at the moment, it does not seem that they are gone for bonds or anything like that. That's another thing they probably can think of, going to the market and borrowing through issuing debentures or loan notes or something like that, which are tradable in the market. Just like shares, they are tradable. You buy it and you can sell it, kind of a thing. You pay, the company will pay what we call the coupon rate of interest, but the people who buy the debentures, they can sell it at a higher price, lower price, depending on the market. Surely, like any other company, they can go for bank borrowings.
Right.
And also, another area that they can look at is venture capital funding. What is venture capital funding mean? Any idea you have on venture capital funding?
No, I don't have no idea about it.
Now, venture capitalists is simply, now banks give loans, right? Banks give loans. There are companies, they have money. What they do is they come and invest in unlisted companies in the shares. They don't give a loan. They can give a loan also, but they invest mostly in shares of an unlisted company. Now, you have a family company, for example, you need money, right? So they will come and say, okay, we will buy some shares of your company. And, your family, maybe 5 of your family members are directors, they will also put 2 of their people into the board. Right? And the idea is, say, they are not going to stay there for long, maybe 5 years, 7 years. They will say, okay, we will be there with you all for 5 years to 7 years, and they will give some kind of expert input to the board of directors. And after 7 years, the idea is they will want your company to be a listed company.
Okay.
Listed company. So once a company is listed, that means the company is doing very well. Then they will sell their shares. They originally bought it at $10 from you all. They will go to the market and sell it at $15 because now there's a market. Once a company is listed, there's a market for the shares. They will sell those shares in the market at a particular price, right? $15 or $16. They will make a big capital gain and they will say thank you very much and they will go off.
Okay.
So the good idea for the company is, if they take money on a loan, they are under obligation to pay the interest and capital on a frequent basis. Here you are not under obligation to pay any capital. You are not under obligation to pay any interest because you are not borrowed. You have taken money on shares. You don't have even to pay a dividend. Dividend is also, because dividend is not an obligation on your part. You don't need to pay anything. But the company, with their input, it will prosper. And once it is prospered, what they will do is they will say, okay, thank you very much. We will now go public, and they will, once it goes public, they will sell the shares in the market and make money. So it's good for the company's point of view. They get some outside expert into the board and money where there is no obligation to pay them back. And after 5 years, 7 years, the disadvantage for the company, the venture capital is not going to look for 10 years, 15 years, 20 years time frame. their idea is only 5 years or 7 years. So you can't think of very long-term plans because they are not interested in your long-term plans. They want things to
Right.
happen quickly, 5 years, and they want to just get out. That is one way.
Okay.
So that's what we call exit mechanism through listing. The other exit mechanism is you don't list the company, but after 7 years, they will say, okay, now time for us to go back. You are not going to list the company. Let's value the shares. So yesterday we remember we discussed the valuation. They will get auditors or some expert parties to value the share. Once the shares are valued, okay, they will say, hey, now if you all want, you can buy the shares. So the existing shareholders can buy their shares, and the company has now grown. The shares are doing very well. The existing shares will be bought by the existing shareholders, and they will say buy and go. So there are two exit mechanisms, one through listing, one through not by listing, by selling shares. Now here, if you really look at, Maintain will not qualify for venture capital funds. Why? Maintain is a listed company.
It's already listed company, yeah.
Yeah. So venture capitalists don't come for listed companies because they have no idea, they have nothing to gain from that one. But they might join in this company for each film. You remember that for each film there's a finance company, no? Like yesterday we saw that LOLC or something, the finance company.
Right.
The venture capitalists can come and take that 40% or whatever the shares. So there's a good opportunity for the venture capitalists to come and invest, and it's an ideal thing. The film is just the 7 years, 8 years the most, and of course you can't plan for a listing because after the film is produced and everything is done, the company, you don't need a company beyond that. Right? So at the 7th year or the 8th year, they will say, okay, let's value the shares, and our parent, the main company, can buy those shares.
Okay.
Maintain can. So that's a good way to raise funds for film companies. And I've seen this happening in most of the world. Venture capitalists come for funding to finance the film company. It's an ideal vehicle for them. Particularly a company like Maintain, who have been very successful in producing films, they know today they invest, the shares will go up when the film is done. They will sell those shares to the existing shareholder, that is the Maintain. Maintain will buy it at a higher price, but Maintain is also not losing because the share prices have gone up, and they had the facility to get finance without any obligation to pay them back. Otherwise, they would have had to pay while producing the film, which is going to be a very cumbersome thing. So this is a way for you to get through your funding. So I can see venture capital funding coming up in a very big way on these things. So you better read a little bit about venture capital. That's the way it happens.
Okay, fine, sure.
Government and similar sources. Very unlikely for the film industry, the government will give any money. But in certain underdeveloped countries, like in Sri Lanka, for example, I remember at one time to boost the film industry, the government decided to give certain facilities at concessionary rates of interest to boost the film. So it also can happen in this country, the Beeland. They might say that, the film industry is going through a bit of a difficult period, and they might ask your suggestion. One of the suggestions may be to approach the government along with all the other film producers, film producing countries, lobby for subsidized loans.
Right.
Subsidized loans. Sometimes the government might come up to produce a kind of a film which may have a kind of a impact on the society. In that case, they might partner, but very, very rarely it happens. In a commercial sector, the government is not interested in film. Government will be interested in the film industry to get their taxes, and because for them it's not a very big deal, and but the government is interested in the taxes. Today the film industry, generally the actresses are very well cared for in most of the developed countries. So they may not have such a issue. But in an underdeveloped country, not in Europe, but in underdeveloped countries, sometimes they might have to have certain kind of fund to care for the the film people, actors and actresses, when they are old and when they are sick, they might have to make a kind of a levy or something like that to care for them. That can happen even in countries like Europe. They might say 2% of the revenue should be given as a levy to care for these actors and actresses when they become old and when they, their makeups are not working, all those things are not working. They are discarded people in the society. At that time, the government might have to take the burden over them and the government might impose a levy or something like
that. Right. Kumar, I have a question here.
Sure.
Yeah. So basically, the one which you discussed, venture capital fund.
Yeah.
Film industry is basically a very risky industry, right? In the precinct says that
yes.
It is risky.
Yes.
And you spend money, but you don't know if you get the return back, right?
Yeah.
So in that case, venture capital fund would be also suitable.
Yeah, because venture capitalists generally come and invest in the risky industries.
Okay, so that is for high risk.
That's why they invest in equity. The bankers invest in low risk industries. Venture capitalists invest in risky industry. They do what we call a due diligence. You remember I was talking about due diligence? They will do a due diligence to find out who are the directors of the company, what the background, all that kind of a thing. And they will put one or two their people also into the board to monitor the affairs.
Right. Yeah.
So they take the risk. That's why they are called venture capitalists. They invest in equity finance. They are taking the risk. Now, banks may not be very, very willing to fund the film industry because banks don't take too much of a risk. And even if the bank says bank will want to money repay all that, film may take a longer period. So ideal fund is the equity fund. And that's what we saw in the OWM. 1 week in Moscow, the equity funding came from a third party. That third party can be a venture capitalist ideal.
Okay, right.
That's what is going to happen because it's a risky industry. Venture capitalists come always for the risky industries.
Okay.
Talking about equity finance, equity basically is what we know is it's a share, it's the ownership in a business, and once you buy shares, you become owners. So Maintain is owned by the public. The public would have bought the shares in Maintain. The public are the owners. So far, the examiner has not told anything about a big kind of a one particular owner. So it may be all over the world or all over the Zealand. People have bought shares in a company, and the idea is the shareholders' monies are entrusted to the board of directors. That is why the board of directors should be subject to good corporate governance, and that is why we have non-executive directors, etc., to ensure that the funds are properly managed, funds are properly accounted for by the board of directors.
Okay.
Shareholders, basically in a company like Maintain, when they invest, what they get is a kind of a dividend. And we saw, I think they have paid a dividend here. And also the share prices will go up and down. So that's the way, say if you invest in Maintain, you might get a dividend and also the share price will go up, and that's what we call capital gain. So that's the way a shareholder will get rewarded. Now, if you look at, on the other hand, if you look at in one of those film companies like 1 Week in Moscow Finance or Summer Night Finance or whatever, the way that they will get is they may not get the share price increase. Because there is no listing. So what they will get is the dividend. But a venture capitalist come in, obviously what will happen is although there is no market, they will value the shares. Obviously the share before the start of the film and after the end of the film, if the film is a success, the share prices will be very high. So we will use one of the techniques what we learned yesterday. The flow price will be always the net assets method, but we will look at the future earnings. We will look at the discounted cash flows, whatever, and we can work out our share price. What is happening here?
Okay.
There are two kinds of shares. Mostly the companies issue what we call ordinary shares. Ordinary shares now maintain, if you really look at
Ordinary
it,
shares,
equity,
yeah.
right? They say equity means ordinary shares. That means the directors have the discretion to pay a dividend or not, and to decide even the dividend amount. And they are not the directors, the shareholders are the owners of the company, but the directors will decide whether to pay a dividend or not, and to pay 10 cents per share, 20 cents per share, 40 cents per share. But generally it is believed to have a consistent dividend policy for a listed company. Something predictable.
Right.
When you invest in shares, you will expect, okay, 2016 they paid a dividend of so much, 2017 they will pay a dividend of so much. So I can plan, to take my family and go for a holiday or whatever. It's a predictable thing. Unlike the females, the business world doesn't like surprises, right? So they don't like to see surprises, surprise birthdays, surprise dividends happening. They like to see things happening in a predictable way, almost. So that's why a listed company must have a very consistent dividend policy. People will be able to predict it. If the dividends are going to change up and down, it's not a very good policy for a listed company.
Right.
So the preference shares is a different one. There what happens is you take money from the shareholders on the understanding you pay them a fixed dividend, a fixed percentage on the nominal value. So whether you have profit, big profit, small profit, you pay the same dividend. But ordinary shares, it's not like that. Big profit, you can pay big dividend. Small profit, you can pay a small dividend. Even with big profit, you can pay a small dividend. Whatever the way you can do it, the directors have the discretion. But if you take money on preference shares, you don't have that kind of a discretion. You must pay the dividend, and you must pay the dividend the fixed percentage agreed upon.
Right.
And therefore, because there's an obligation on the part to pay a dividend, so long as you have profit. If you don't have profits, of course, you don't need to pay. But the moment you have a profit, you must pay the dividend. Ordinary dividend, you don't need to pay even if you have profits. So because of that, the preference shares under our IAS 37 is now reflected as a non-current liability. Even though it is shares, it is reflected as a non-current liability. The reason being, there's an obligation to pay the dividend, so long as we have profit. What is the preference share? In a winding up, they will get their share money before the ordinary shareholder. They have the preference. They have the preference to receive money. And also, they have the preference to receive dividends before the ordinary. You can't pay ordinary dividend without paying the preference dividend. So they have the preference for dividends. They have the preference for the winding up. So that's another kind of a source of funding that may be available for a company like Maintain for the film. For the film, right? For the particular film, they can go to the market. Not to they can go to certain people and ask for preference shares. Preference shares means it's for a fixed period. We know the film is going to be 7 years. We say 7 years, and for 7 years we will be paying, every year 8% on the nominal value, a fixed dividend. You are not compelled to pay a dividend in fact you can't pay a dividend if the company is making a loss. But when the company is making a profit, you have to pay the dividend.
Yeah.
And that's the difference between a loan and a preference dividend. Loan, whether you have a profit or not, you are under obligation to pay interest.
Right.
Preference shares, you are under obligation to pay dividend only if you have a profit.
Okay.
Ordinary, even if you have profits, you are not under obligation to pay any dividends. So that is why ordinary shares are considered equity. Preference shares are considered non-current liability. Loans are considered non-current liability because wherever there is an obligation, it's a non-current liability. So this is the difference between preference shares and debt. Preference shares, it's a dividend what we pay. For debt, what we pay is interest. Interest is expenditure and therefore it is tax deductible. Right? We charge to the P&L interest, we charge to the P&L salaries, we charge to the P&L all the operating expenses, all our expenses which are tax deductible. But preference dividend and ordinary dividend both are paid out of profit. Profit after tax.
Okay.
After profit after tax only we can pay the preference dividend and we can pay the ordinary dividend. So therefore they are not tax deductible. Both the dividends are not tax deductible because they are paid out of profits. Right? So that is why sometimes it's not very attractive to issue preference shares from a company's point of view because they can't deduct it for tax purposes. Loans, if they take it, they can deduct it for tax purposes, whatever interest they pay. So there are types of preference shares. Cumulative preference shares. What do you mean? First year you don't pay a dividend, 7%. Next year you must pay with the arrears.
Right.
14% you have to pay. Second year you did not pay. Third year you have to pay 21%. Before you can pay any ordinary dividend, you must pay all the arrears cumulative preference dividend. If you say non-cumulative preference shares, okay, first year you did not have profit, you did not pay. Second year you don't need to pay arrears, you just pay the 7%, that's all.
Okay.
Right? Then we have something called participating preference shares. Generally the preference shareholders have no participating rights. In other words, they can't come and ask any questions. They just have to get the dividend and just wait. But there may be certain conditions where they are given the facility to participate and they can ask questions and whatever. Sometimes the preference shares are issued with convertibility. Now what is convertibility? It is initially issued as preference shares, but the shareholder will have the option to convert it into ordinary shares at a later date. The option is with the shareholder. So you buy some preference shares, you are entitled for a 7% fixed dividend and you are quite happy. But you see the company making big profits and company is paying big dividends for ordinary. So at that time, you have the option, if the option is given to you, to convert it into ordinary shares.
Right, yeah.
So that can be there. Generally, the preference shares are redeemable. Redeemable means it is taken for a particular period. So in Maintain, I think it will be always redeemable preference shares for a particular film because maybe after 6 years, 7 years, there is no use of that funds because the film is gone and they want to return the money. So they will return the shares.
Okay.
Right? So that is what we will be doing, redeemable preference shares. If they say irredeemable preference shares, then of course there is no obligation to redeem, but still because there is an obligation to pay a dividend, it will be still considered non-current liability.
Okay.
So the capital market, that is the stock market, basically has two functions for the society, two functions for the business. Number one, we call it primary function. Now, a company like Maintain, listed in their own stock exchange, for the very first time when they come to the market, they can issue shares to you and me and everyone. The company will get money. Right? So it's a direct transaction between the shareholder and the company. Company gets money and shareholder gets shares. That's what we call the primary function. The company can issue debt, bonds, company gets money, we will get the bond certificate or whatever, and that is what the primary function. Now after Veena has bought some shares in the company, Veena needs some money, right? Veena needs some money. So now Veena can't sell the shares back to the company. That's not allowed unless there's very specific law. You can't sell it to the share. You can't say I want to sell my shares to the company. No. What Veena can do is Veena can go to the stock exchange, get hold of a broker and say I want to sell shares of Mentene, and you will say that. And I go to the stock market and say I want to buy shares of Mentene to my stockbroker. So in the stock exchange, Veena is prepared to sell, Kuma is prepared to buy. So the transaction is between Veena and Kuma. That's all. Company does not get any money. Only thing the company is advised, now no longer Veena is the shareholder, the Kuma is the new shareholder.
All right.
So the new dividends will come to Kuma and not to Veena. That's all. Of course, Veena had 100,000 shares. Veena can sell 20,000 shares and keep 80,000. So in that case, Veena will get dividends for the 20,000, 80,000, and Kuma will get the dividend for the 20,000. That is what we call the secondary function. And because of the secondary function, the shares of listed companies are very attractive because it has a market at any time. It's like almost cash. At any time, you can just go to the market, sell your shares and collect your money.
Right.
That's what the capital market. So there are two functions. So as far as Mentene is concerned, now they are already a listed company. So they can't come to the market and issue shares on an initial public offering. But they can come to the market and issue shares as a primary function to the existing shareholders. That's what we call a rights issue. Right? They will come to the market and they will say the rights issues are available to all the existing shareholders, and that will be a primary function of the BEAL and stock security. After that, shares will get moved up and down between the many people. That is what we call the secondary function. So we can see in this company, there is one listed company, the Mentene main company. Then we see the Mentene Distributors is an unlisted company. Then there are many unlisted companies. All the finance companies, all the production companies are all unlimited companies. Sorry, unlisted companies. Unlisted means you can't sell shares to the public. You can sell shares in private. You can invite a LLC. You can invite a venture capitalist. But you can't go shares and sell to the mass public, and those shares are not marketable. So Mentene have two types of companies. Its own company being a listed company, they can sell shares to the public at any time. But the other companies are unlisted companies, so they can't go to the public and sell shares in those companies unless they list it. There are a lot of advantages of listing because it gives you straight away a valuation for your shares. Immediately you know your share value because there's a ready market. Some companies, they might want to go for listing purely to realize their paper profit. Now Mentene has already gone, but Mentene can take their distributing company also to the market because they have one distributing company. They can go to the market and they can list it to raise money, also to realize what we call paper profits, because paper profits are now you and your family whole shares in a company, your family company, right? And you can show your share certificate to your husband and say, yeah, I'm a shareholder of my company and all that. But that money, that profit is not convertible because you can't sell. Unless your sister is prepared to buy or some person in the family is prepared to buy, you can't convert it into cash. But the moment if your family company goes public, listing, you can convert it. So, one company which can go listing in the Mentene structure is that Mentene Distributors. Because Mentene Distribution is one company which is owned by the parent company. If the parent company wants to raise money or the distribution company wants to raise money, they can go to the market and list it.
Right.
If they list it, it will have a share valuation. It will provide a mechanism to buy and sell shares in the future. Definitely when you say you are working in a listed company, or a listed company means it's a kind of a big, what do you mean? Their reputation is very high. Now when you say you are working in a listed company in UK, is totally different from saying you are working in an unlisted company. Because the listed companies are highly regulated. There is always the belief that there is good corporate governance, and therefore generally it attracts the best people for employment. Right? So it raises the profile of the entity. It gives the facility to raise capital for the future all the time. Anytime they can go to the market and issue rights issues and bonds and all that. And what do you know about employee share option schemes, Veena? I think in this question there can be another one on that one, ESOP. Employee share
option scheme. Yeah, basically, employees are given option to buy company shares at discounted price.
Okay.
Um,
What's the idea? What's the idea?
To make employees also participate in the company's success, something like that.
Yeah, it's basically actually it arose in America in somewhere 1980s or something like that. There was a big problem with this share, with the directors getting big salaries. So I think one of the presidents of America and the government decided the maximum the directors can draw is 1 million for a month or something like that, right? So, what the directors realized was whether you work or not, the maximum you get is only 1 million. So, by 1 o'clock, 2 o'clock, they were not interested in working anything more than that and making big money, because whether they work or not, they can get only 1 million. So they started going home, packing their bags and going home and sleep, whatever. So what do you think what happened to the companies? The companies started collapsing. Because the directors are not working, because only the directors direct the company and control the company, it's not going to happen. So there was a need to look to do something. So at that time, the idea of this share option scheme came. What is a share option scheme? You join the company today, right, on the 3rd of February. You're told, okay, Veena, you join the company, you work with us for 3 years, right? After 3 years, at the end of the 3 years, you have the option to buy 100,000 shares at a predetermined price. So they decide the price today. So today market price may be 9. They will say, okay, in 3 years time, you can buy it at 10. You can buy 100,000 shares at 10. So you work for 3 years and you work very hard. And because you work very hard, the share prices of the company goes up. Right? Company is doing very well. And now after 3 years, the share price is 12. So, but you have the option to buy it at 10. So you buy it at 10, which is worth 12. So immediately you have got a big wealth increase of 200,000 through the share option scheme. You can sell it, you can retain it, whatever you want, you can do it. The option is yours. If you don't say, if you are not interested in, if the market price comes down, you will not buy. Right? You will not buy. So it's at a predetermined price, not at a discounted price. It's at a predetermined price, but it gives you all the incentive, the motivation for you to work harder and to increase the share price. If you work hard and make it $3, 13, you have a $3 gain, kind of a thing. So that way, the Americans, they managed to get over the remuneration problem, because that made people work harder. And through that one, they got the big money into their hand. Not in form of a remuneration, but in form of share appreciation, which was acceptable. Because when the shares appreciates, not only the directors know, even the shareholders get the benefit. The idea is to maximize the shareholder wealth. No? So directors work very hard, share prices goes up, directors benefit, the other people also benefit. That's the idea.
Right.
And the idea was because, why do we pay a remuneration for people? We pay a remuneration to attract, to retain, and to motivate. These are the three reasons why we pay a remuneration: to attract, retain, and to motivate. Right? So by giving a share option scheme, you can attract the good employees, the potentially good people, because they have something more than the remuneration to look at. So you can attract.
Okay.
Then you can retain. Even if you get another job in 2 years' time, you are not going to leave the company and go, because you know in third year, if you wait, you are going to get a 300,000 bonus. You can retain people. And also to motivate. There's a big motivator for you, because do well, share prices goes up, you will be benefiting. And when you benefit,
Right.
it's not only you, other shareholders also will benefit. So this is what we call goal congruence. Goal congruence. All are benefiting. All are working on the same aim. So when the companies are listed, it's much more visible your gain. Even in an unlisted company, you can have a share option scheme, but the gain is not visible. But the moment it is listed, the moment you work till 2020, you can see the visibility of your gain. So that's what a share option scheme. So because of the listing, that can come up very handy for companies all the time. So one company that I can think of going for listing here is Maintain Distribution. It's very unlikely the film companies will go for listing, because the film companies have a very short life period. After the film is done, it's gone. So very unlikely it will go for listing. But Maintain is already listed. You can think of listing Maintain Distribution. I think that is why they are given that Maintain Distribution for us, because that's a company. The production companies, again, we can't go for listing, because they are for a very specific film, and the film has a short life period. After that, it is over. So they might ask you, okay, we want to list the Maintain Distribution. What are the advantages we saw? What are the disadvantages? Disadvantages, you have to give lot of reporting requirements. Now, a company like Maintain, I don't think it is going to be a big issue, because Maintain is already listed. So Maintain subsidiary also, I suppose, they can do that one. I don't see any particular reason why they should keep it as a private company. It's a good mechanism, good vehicle for them to raise some money, rather than raising to Maintain main company. They can raise it to the distribution company. Where distribution companies are very attractive. Distribution companies only make the profit, because all the films are bought by the distribution company, and the distribution company only makes the final profit. Isn't it? Right? So the rules to obtain a quotation may be very stringent. So maybe in the Maintain Distribution, they may have to do certain changes in the corporate structure, because the moment the company listed, you need to have corporate governance. You have to comply with various regulations, etc. So there may be certain things what we need to do.
Okay.
Then the UK, now this is UK, we have to remember that one. We are in a company in a fictitious country called Beeland in Europe, but normally in most of these big markets, we have two stock exchanges. One we call the full stock exchange, the other one what we call the alternative investment market. The idea is that in UK we have the London Stock Exchange and we have the AIM. The idea is in the London Stock Exchange, the top big companies are listed in that one. Right? The top big company, the mature, so-called the mature companies. The mature companies. They are what we call the blue chip companies. Maintain may be listed in the full stock exchange in this country. Maintain being the largest film manufacturing company, surely they are a mature company that will be listed in the main stock exchange. It will not be London Stock Exchange, but they might have a separate stock exchange, the main stock exchange. the scrutiny for those
Right.
companies are very, very high. I mean, they are really exposed. Everyone is looking at their company, so they have to be extremely careful with all their conduct and everything like. Very high,
Right.
and shares are extremely marketable because, everyone knows by name that company. Then we have a second stock exchange that is for, smaller versions of the big companies to come and get listed. I would imagine Mentee distributions are going, they will get listed in the alternative market.
Okay. Yeah.
Alternative, because, entry costs are not very high, and reporting requirements are not so stringent. So it may be good. I mean, if you are going to make a recommendation, you will say to go to the second market and get your company, get the Mentee distributor listed. The idea of two stock exchange is simply the big stock exchange, they are mature companies, they don't need too much of capital investments, right? Because they have already got their investments, they are well known, and even if they want money, they can just go to the market and raise money. It's such a reputation they have. So because of
Right.
that, they can pay big dividends. They can pay dividends.
Right.
So if you as a shareholder, you might be thinking in terms of annual dividends, right? To look after your children's education or whatever, you want an annual dividend. You want a dividend. Now, that kind of a person must go and invest in shares of the big stock exchange listed company. The smaller version of the companies, what happens is they want lot of investment. They are growing companies. Mentee distribution may be a growing company. They need money. So what they do is they don't pay big dividends. They retain funds. They don't pay big dividends. And with the funds, they grow, and grow. When they grow and grow and grow, what happens? The share prices goes up.
Yeah.
They pay little dividends, but the share price goes up. Now, for example, you might think, I don't need money now because I'm doing well, right? I don't need money, but when my baby is big, I need money. So you go and invest not for annual dividends, but you invest for capital gain. You are thinking after 5 years, when the child is big, I want some money, and for that purpose, go and invest, and then they will think of investing in those secondary stock exchange, the alternative investment market. So the shareholder will decide in which to invest depending on her or his requirement. So if Mentee is listed in the main stock exchange, Mentee will be paying regular dividends, but the other company, Mentee distributors, can get listed on the smaller stock exchange, and through that one, they don't need to pay dividends. They can just grow, and keep the share price going up. So the people will benefit by share price increases much more than the dividend. Just like venture capitalists, there is something called private equity partners. This is almost similar to venture capitalists, but this is another term that we use. It's the people with money, companies with money, they come and invest in shares. Mostly they invest in public companies. Now remember, venture capitalists, where they invest? They invest in unlisted companies. They invest in family companies with the intention of taking you to the public.
Yeah.
Here the other way about, opposite direction. A public company wants to get delisted, right? Because the public company might feel, my God, these fellows, we have to give so much of information, not worth, let us get delisted. So what they do is they get a big private equity partner, and they will buy all the shares in the market through the private equity partner. And you make your company delisted. So if you are thinking of going for listing, you will go for a venture capitalist. If you are thinking of getting your company delisted, you might want to go for private equity.
Private equity. Yeah.
So for example, our maintain, if they think that this is a real troublesome area, people asking all sorts of questions and we have to answer these films is creating a lot of problems, they might want to delist it. If they want to delist it, think of a private equity partner. Private equity partner and get themselves delisted. Or sometimes a company that is not going through a good period will get private equity and will do very well, and then later on they can get themselves listed. So either way you can get it. Private equity partners, they will invest in equity and also partly in loans. The idea is if you put all your money in equity, as you said earlier, it's a risky thing. But if you put part of the money in equity and part of the money in loans, then even if there's nothing coming on equity, you will get your interest on the loans. So that is what we call leverage buyouts, LBO, leverage buyouts. A fair amount of money in debts and fair amount of money in equity, leverage buyout. That is what we call leverage buyout. So whenever we go for a share issue, we have to have a certain advisors. One is an investment bank. So whenever we want to go for a new, now Maintain Distributors is a good company to go for an initial public offering. Maintain cannot go. Maintain is already a listed company, but Maintain Distributors can go to the market, issue shares, and that will be they can come for an initial public offering. So whenever they want to go for a public offering, they must get the advice of an investment banker who will arrange everything for the company. One arrangement that we have to be very careful, mindful is underwriting. What is underwriting, Veena?
Basically, an underwriter is appointed, and shares are issued. So if the shares are not bought by any shareholder, the underwriter buys it, and I mean he charges some fees of some percentage of fees for that risk that he takes.
Very correct, very correct. Yeah, that's right. It is because whenever we come out with a share issue, we are not sure whether all the people will buy the shares. It can be an initial public offering. Why are we coming to the market? Because we want to raise a particular amount of money, isn't it? Right? So we want to raise 100 million. So for example, if we get 80 million from the public, we can't do the project. We need 100 million.
Right.
So there's a risk of all the time that balance 20 million not coming through. So before you issue the shares, you come to an arrangement with so-called underwriter. And by arrangement, with the underwriter, you say, okay, I'm coming out with 100 million. And they will say, okay, you give me 4% of the total amount. So 4 million or whatever, the figure. And then he agrees to underwrite. What do you mean by underwriting? Any shares not bought by the public, he will buy.
Right.
So the 20 million that were not bought by the public, he will buy it. So the company gets the company's 100 million. Of course, company will have to pay underwriting cost of 4 million. That's expenditure. But the company is now sure whether the public buys or not, it doesn't matter. Directors can sleep very well in the night because they know they will get their 100 million either from the public or from the underwriter. If all the public buys all the shares, underwriter has nothing to buy, but still we have to pay the 4 million. It's like an insurance premium, right? Whether we meet with an accident or not, we have to pay the premium. It's like that, we have to pay. And underwriter, after buying those shares, later on he will go and sell it in the market, and he might sell it at a higher price. He will collect his money. That's what he does. Even a rights issue, you have to underwrite it. Because rights issue means you are coming to the existing shareholder. Not that every existing shareholder, however attractive it may be, you may not have money, I may not have money when the company offers. And if I don't buy, if you don't buy, then company will not get the required amount of money. Then the company what he does is, the underwriter is there, underwriter will buy all unsubscribed rights.
Okay.
That's what underwriter. So whenever we come for a public issue, it's good to have an underwriter underwriting the whole issue. The idea is to ensure that we get money that what we want. Stockbrokers, they are the people who are in and out of the stock market. They know what shares are moving, what is the time to issue shares. They are the real experts. They are really at the ground level. So they will be able to advise us a lot on a share issue, what time to come to the market. Is it a good time, May, February, whatever, that kind of a thing. Then as I said, there are two kinds of investors in the market, the individual investor and the institutional investor. You and I, we put our money, we are individual investors. If the company does well, we will get our dividends, everything. If the company does not do well, we may not get anything, we might lose our money. You might get scolded from your husband. That's it, but your money, you are lost it. Institutional investor invest not their money, they invest others' money. For example, you are working in a company, they promise you a pension, and that pension contribution, they go and invest elsewhere in a what they call a pension fund. Right? In a pension fund. Now that pension fund has lot of all the pension money of Veena, Kumar, everyone's pension money. They go and invest in other companies, in companies. So they are institutional investors. So if something happens to the company, it's not the people who decided to invest the money, the loser. It is the third party like Veena and Kumar who had no decision in making the investment, but we will lose our pension. Right. So because of that, the institutional investors need to be more careful when they make investment. And for that purpose, they have a lot of experts of the industry, of the investment in their staff. So they will be in a better position to tell us about the market, what's happening around in the market, etc., etc. So we have
the institutional investor. So the institutional investor, because they will be looking to a low risk industry, to a low risk company. So they might not be able to, they might not want to invest and maintain, or it can be a chance.
It is very subjective, because the maintain maybe because looking at their past success, because the institutional investors, what they do is their pension fund, they invest in many portfolios. They don't put all the eggs in one basket. They might put up in a company like Maintain, take it a little bit of a risk, but looking for higher returns. They might put it in government treasury bills, some money, looking for a lower return. They mix up. They have a kind of a thing. But of course, they have to be extraordinarily careful rather than an individual investor, because individual investor, it's like my car, my petrol, I can invest whatever. But when they invest, they have to be aware they are investing other people's money. For example, banks. So when they have a lot of money, they have to go and invest elsewhere. Right? Of course, they give loans, but the loans itself is not good enough. They will go and invest elsewhere. So bank is an institutional investor. Bank takes your money, bank takes my money, and they go and invest in Maintain. If Maintain collapses, your money, my money is unprotected. So the banks will do a lot of due diligence, etc., and bank will decide to invest on that kind of a thing. Right. So tomorrow I'm going to continue from here to the rights issue, because I believe still there is a rights issue happening here. So I think even in the last paper there were questions on the rights issue. So we will talk about in that area tomorrow. I think tomorrow we are meeting at 10 o'clock, no?
10 o'clock, yes, tomorrow.
Shall we meet at 10 o'clock and look at some of these areas, and look at some, maybe we can look at another mock course tomorrow.
Right. And Kumar, after that, what would be the plan? Like after we complete that mock as well, and the finance structure that we are studying right now. What do you plan ahead?
After that, what we can do is we can look at again. I want to look at some of the technical things like the change models, etc. Right, and continue with our mocks and that kind of a thing, unless you have anything very specific.
No. I just wanted to know, like, you know, how would we be progressing
What we
on
will be doing
the.
is we'll do a mix of technical models in certain areas. I must still try figuring out very areas that it can come up in the question paper. Look at some mocks in certain areas, but they can be probably. So this is an area that may have something, the funding, because in F2 it's all about funding. So we might have something for funding. So we will try to look at different alternates and try to work it out, something.
Okay, and Kumar, just last thing, like,
Yeah, sure.
can we spend like 15-20 minutes on something called transfer pricing? Would that be,
yes, we will do that one, because I think here in this
is it,
paper there may be transfer pricing, because the film that is being produced by the finance company need to be transferred to our distribution company at a transfer price.
yeah, so I just wanted to, I mean,
we
if
will
you
do
can
that.
spend like 15-20 minutes on this,
Sure,
because I don't have a lot of clarity on this subject.
Okay, sure, we will do that
So,
one. So
yeah.
maybe now tomorrow we have a meeting. Then after that we have to decide your plan. How is your plan next week?
I am free for the entire week. It's fine. Any day is okay.
Okay. How is your, say, 12 o'clock time, all right? Or Monday?
Or which day?
Monday I can do it any time, like Monday. Monday I don't have any problem. Anytime I can
If you
manage
can,
it.
like, if you can do it on Tuesday or something.
Tuesday I can
Do you
do it.
have any
Yeah,
Tuesdays?
Tuesday I can do it at about 12 o'clock. I can do. No, Tuesday.
Tuesday 12 is fine.
Sorry, Tuesday. No, sorry, Tuesday. I have my church.
Okay. Wednesday?
Wednesday, no problem. Yeah, Wednesday should be. Evenings, are you free?
Yeah, I'm free. Evenings like what time?
Say Wednesday, say 4 o'clock in the evening, Wednesday?
Perfectly fine.
Yeah, so shall we make it Tuesday? I may be a little bit stuck with my church programs, but Wednesday I can do it at about 4 o'clock in the evening.
That's all right. It's fine. It's fine by me as well.
So we will keep for the moment. Tomorrow we have Saturday. Then shall we make it Wednesday?
Wednesday, yeah.
4 o'clock?
Yes, 4 o'clock is fine.
So I'll keep it that for the moment booked for you. Yeah, sure. So I'll see you tomorrow, whatever it is, 10 o'clock.
No problem, Kumar. All right.
Okay, Veena, take care. Have a great day.
All right. Thank you.
Bye.
You too, sir. Bye.
Bye. Bye.